Hi, thanks for joining me. My name is Jay Shabbat, and I'm with Econ Weekly. And I'm going to talk today about the state of the US economy. During the past 18 months or so, we've had a wild up and down in terms of economic trends. And we're going to talk a little bit about where we are today here on May 2021. We're going to start with identifying three important trends. Firstly, that the demand in the economy is very strong. Um, Never a bad idea when you're talking about economics to start with an analysis of where supply and demand is. So we'll start with demand, and right now it happens to be very, very strong in the economy. And one way to look at it is it's like a jet with three engines, and the three engines are one, fiscal stimulus, two, monetary stimulus, and three, just the reopening of the economy after COVID. What is, just for those who are may not be familiar with all the terms here. So fiscal stimulus, really all we're talking about here is the government's spending and taxation. So in this case, we're talking about the federal government. Of course, the US has multi-layers of government. It's not so much state and local governments we're talking about, but the federal government in Washington. And right now they're providing a lot of stimulus in the form of sending checks to people, extra unemployment insurance, and so on. Monetary stimulus is just referring to Federal Reserve policies of doing what it can to expand the money supply, to make borrowing costs lower and whatnot, to facilitate the economic recovery. So, what industries are benefiting most from these three forces? Well, during the pandemic, other than maybe very early in the crisis, let's say as starting last summer, what we saw is an economy that was very much, you might say, home centric. Homes themselves were selling very rapidly. Demand was very strong. That remains the case today. But really, anything else that had to do with the homes, to do with people's homes. So that could be repairing homes, things that people do to entertain themselves in their homes, furnishing their homes, even providing education in the homes, in their homes. So really, anything that people did at home because of the pandemic, people were forced to stay at home in many cases, or working at home, schooling at home. That created a lot of incentive to make the home more comfortable, to make the home equipped for the things that you needed to do. That really remains today, even as we come out of the recession, or I should say, out of the pandemic. This home-centric idea of the economy doing really well in this part of with these home-centric purchases, that still remains the case today. There's some evidence of a shift away from that a little bit. Talk about that in a moment. But for the most part, that still stands. Automobiles also very strong demand, and now you're starting to see a strong demand for some of the away from home activities that were really off limits to a lot of people during the pandemic. So that means going out to restaurants, taking a trip to the beach in Florida, go and visit grandparents in Arizona. That kind of stuff is starting to come alive too. Which parts of the economy are not experiencing strong demand? There are some. There is, as I mentioned, some faint signs that a shift is starting to begin between spending for things at home versus spending things outside of the home. And an example would that be, Netflix said their sales growth has slowed recently. As you can imagine, people might be spending less time at home watching movies these days. So there are signs of that. The other things that still remain depressed are, long distance travel. Nobody's going overseas for vacation right now. Uh, and that's going to hurt big industries like aviation. And, when you talk about a company like Boeing, for example, Boeing is the largest exporter in the United States. And it has a whole ecosystem of suppliers that just employ thousands upon thousands of people. That remains very depressed. I mean, Boeing is not selling many aircraft these days. I mean, if anything, they've may have picked up a few orders from U.S. airlines, ordering some of the smaller planes that it builds. But when you're talking about some of the higher margin, very long distance aircraft that it was selling to China and Europe and the rest of the world, that's still very much dormant. Uh, Global demand more generally is still weak. So if you're an exporter and not just Boeing, but if you're selling anything abroad, chances are now is not a time when you're seeing very strong demand. And finally, commercial banking. Now, don't shed a tear for the banks. The banks are perfectly healthy, but mostly because of activities like investment banking, you know, things that fall under that category would be, raising money for companies, also, fees that banks earn for advising on mergers and acquisitions. That sort of stuff is gangbusters right now. So banks are doing fine, and even other aspects of wealth management is another area that's doing fine. A lot of this money that people are receiving, whether it be stimulus checks or whatnot, a lot of that's kind of getting filtered into investments, and banks have people that manage that sort of thing. All that stuff's doing great. But when you talk about banking, what you're really at the very core of banking, the essential function is lending, and there's just not a lot of demand for loans right now. And that's important because there's thousands of banks across the United States, many of them pretty small, local. Um, so that is somewhat of a concern. Now, when you're talking about loans, with all of this stimulus, you do have people that are repaying the loans that they've already had. So the default rate on loans is very low right now, which is good for banks. But there's just not a whole lot of demand. If you're getting a big check from the government, chances are you're going to use some of that money to pay back your credit card loan rather than need to take on new borrowing. Okay, now let's go to the second point, which is that at the same time as demand is doing very well, uh, supply is very much constrained. And we see this in a lot of things that companies need to build their products, whether it be raw materials or commodities, even shipping containers. The fact that shipping containers are in short supply right now is causing all sorts of bottlenecks in supply chains. And you'll hear, you know, was listening to, for example, an earnings presentation from the motorcycle maker Harley Davidson. And they're saying, yeah, look, our supply chain is just really tight. We're not getting the things we need to build our motorcycles on time. And you see that it's very pervasive throughout the economy right now. There's a lot of things in short supply. Three things though that I want to highlight that have sort of an outsized impact. One is the semiconductor shortage. Now, I never before doing Econ Weekly, I never realized quite how vital these little semiconductor chips are. They are not only probably the most sophisticated thing human beings build, they're also in so many products that we use. Now, of course, they're in computers and mobile phones and electronic devices, and naturally, as you know, we're using a lot more of those these days. But they're also in everything, from automobiles. I mean, cars these days are really just a big computer, and what we see is really very long supply delays, production delays for the auto manufacturers because of they just can't get their hands on the semiconductors that they need. So this is it's rippling really throughout a pretty big part of the economy. The second thing is the housing shortage. So not only is there a lot of demand for housing because of all that's going on in the economy, people want to be in more comfortable homes, they want to upsize, whatever. There are even demographic shifts that are conducive to demand growth with housing. But at the same time, there's a really major shortage of housing in a lot of markets across the U.S. And a big reason for that is quite simply the last crisis in 2008, 2009. Housing was at the center of that, and the problem was just the opposite. There was too much overbuilding. So a lot of home builders are now, for the past decade, have been shy about building too much. And ultimately now there's just not enough in many markets. So, there's that. And on top of that, we'll talk about this on the next slide, but the cost of building a house is going up for a variety of reasons. And one of the reasons, in fact, is that there is a labor shortage, of people to help build houses. But it's not just unskilled; it's skilled. That's very important. Um, Crazy enough, but restaurants, which laid off tens and tens of thousands of people during the pandemic, are now starting to slowly hire back again, but they can't find workers, which would seem odd enough because of the all the people that were laid off. You think there would be a wide pool of labor to draw from, but that just really hasn't been the case. And there are a couple of theories why. Uh, One is simply that the unemployment benefits that were included in some recent government spending packages are relatively generous, at least compared to what they normally are. So there may be some people who are okay, or are not feeling as much pressure to get back into the job market. Perhaps they're living with a relative, perhaps a spouse is working. So there's that kind of relieves some pressure. Perhaps that's a reason. There's also things still related to the COVID pandemic. It's certainly not over. School closures example, a lot of schools still either close or only going half days. So a lot of parents still need to maybe spend time at home with their children and unable to go back to work. Same thing, they may have some health related fears. For example, they can't go back to work because they have a condition that's very dangerous and they're not fully vaccinated yet. The also even just caring for a relative who might be COVID exposed. There's still a lot of that throughout the economy. So will they come back? Eventually before long. That's kind of a big debate. And skilled workers too. You see a lot of workers that require certain licenses. Truckers, for example, or construction. Electricians and things like that. That's really tight right now. Now, what's not in short supply? For sure, capital. I mean, it's if you want access to money, you can get it pretty cheap. Of course, all things else considered, depending on your credit and all that. But I mean, the benchmark rates for lending are extremely low by historical standards. So access to capital is certainly not a problem. And then there's some areas of the economy like commercial real estate. If you're looking to rent an office building in Manhattan, right now you're going to find that supply is very much the opposite of constrained. So what do we get when we have very, very strong demand and constrained supply? This is economics 101. You get rising prices. And indeed, that's exactly what's happening right now in the economy. You have housing prices rising very rapidly, autos, food, energy. You can see the list there. Financial assets as well, stocks, crypto assets like Bitcoin. You see that's been kind of all the rage over the past year or so. And even everyday consumer goods, Procter and Gamble's raising the cost of toothpaste. I don't know if that's exactly true, but just they mentioned that they were in general raising prices. So there is definitely a situation of rising prices. Even restaurant meals. I heard one company in their earnings call say that people are ordering bigger and more expensive steaks, and they can't find enough waiters and kitchen staff, so they are sure enough raising their menu prices. Now, the real question here is, okay, fine, so we've got prices that are going up, but how long will we be in this situation? Is this just kind of a temporary situation, or transient is the word the Federal Reserve likes to use? Or is this something to worry about? Now, just a brief moment, I want to talk about inflation and why it's such a concern. We really haven't experienced sort of entrenched inflation since the 1970s, but it is something that worries economists because of all the distortions it creates in the economy and because of who it could potentially hurt. Just imagine, when prices are constantly spiraling upwards. And again, here we're talking about something sustained. We're not talking about something that prices are up tomorrow, but maybe they'll fall, in 6 months from now. We're talking about something where people start expecting like, oh wow, this sofa that I really want, it's going to be more expensive 6 weeks from now or 5 months from now. So I need to buy it now. So you have a situation of people kind of bringing their consumption forward, and that creates all sorts of headaches for suppliers. Uh, you know, how do you um, how do you meet the needs of consumers short term, and then when you're thinking about the long term, are you going to stop investing? Are you not going to invest as much because you think, well, I don't know what people are going to buy in the long term if they're buying everything now. So it does create a lot of distortions. It also, imagine for people who are saving money, let's say you buy a government bond, and that bond promises to pay you, let's just keep it simple, promises to pay you $1 um, in 6 months from now. Well, if that dollar today buys you let's buy you a hot dog. But 6 months from now, the hot dog costs $5, and the only thing you can buy with $1 is just one French fry. Well, that's your dollar's devalued, and you're becoming poorer. That investment that you made is no longer what you thought it would be. So you have also a lot of people in the economy who are investing money. And in this case, you're talking about a lender, right? You're lending the money to the government when you buy that bond. So any other lenders in the economy, whether it be banks or whoever, is going to be experiencing those difficulties that come along with inflation. To be clear, deflation is arguably even worse than inflation, where prices are constantly falling and people are not buying anything today because they're holding on to their money. They think everything's going to be cheaper a few years from now. Japan had a little bit of this issue a decade or so ago. Well, that's bad too. But inflation um, certainly has its down points, and that's why the mandate of the Federal Reserve is to keep prices stable. That's the key word is stable. You want them to be. So will they be stable for long, or do we have this problem of kind of long run inflations? Is the 70s coming back again? And the real interesting thing, I mean, if you're into uh, if you're observing the economic debate, is that you'll find people with excellent credentials and excellent track records, and very smart people, distinguished people on both sides of this debate. So we're going to discuss a couple of arguments for and against the thesis that inflation is going to be a concern again. And the people who say yes, one thing they'll say is that, and this is kind of central to their argument, is that the stimulus is so large this time. I mean, there's just the trillions of dollars that Congress is allocating to the economy, and not only just allocating to the economy, but they're actually putting it in people's pockets. And we call that helicopter money. I think this comes from the former Federal Reserve chairman, Ben Bernanke, I believe, coined this term when he was a Princeton University professor. And this idea that you're just kind of dropping money from the sky and it's going directly into people's pockets. And of course, they're going to spend it. And of course, they're going to, drive up demand, but in doing so. So that, in a sense, from this argument's perspective, poses some risk, some inflation risk. The Federal Reserve, meanwhile, because its interest rates are so low, or the interest rate that it controls to influence rates is so low that it's just extremely easy to borrow. There's a lot of money in the banking system, or at least a lot of lending capacity in the banking system through this idea called quantitative easing, where the Federal Reserve is actually putting reserves into the banking system to get lent out. And then simply that, the Federal Reserve actually changed its policy. They used to, 2% used to kind of be the tripwire line, the line that's 2%, we got to move back. Now they're kind of saying, well, we're okay if we go a little bit over 2% for a while. So we just want an average of 2% over time. So that higher tolerance for inflation perhaps makes inflation more likely to happen. Now, these arguments, some of them, were very much in vogue after the last crisis, when the Federal Reserve also got very aggressive about trying to expand the money supply. And people said, inflation's coming, inflation's coming. And I remember them, screaming on CNBC and all these cable. And guess what? Never happened. But in fairness, some of these people and some people who are not in that camp back then are arguing with, I think fair reason that this time is very different. Now, one reason stimulus is just simply a lot larger. $787 billion was the amount of the congressional act in 2009. That's how much money was pumped into the economy then. But very shortly thereafter, within years, what you had was just kind of the opposite happening. Instead of stimulus, you'd have contraction. And that was occurring through one example is the federal sequester. I don't know if anybody remembers that. Some of you perhaps do. Congress was very concerned about the rising deficits and the rising debts. So what they did was they passed a bill that actually was a compromise between the different parties, and they actually decreased spending for things like the military and social spending and whatnot. So that actually removed some demand from the economy. SLG here, you'll see that stands for state and local governments, and they were also kind of cutting. They had very difficult fiscal circumstances in the early 2010s. They were cutting too, which was another example of taking away from demand. In this case, it is very different. There's just a lot more um, stimulus that's out there without being negated by any contraction. It is just a very, very, very different state of the economy. One way to look at it is that back in 2008, 2009, there was a lot of things. There were sort of central arteries of the economy that were essentially broken. Housing was broken. Finance was just broken. Households were in debt. They had these expensive housing assets that they were underwater. They were worth much less than they paid for them. You had a credit crunch. Banks wouldn't lend. This is very different this time. We just talked about in the first slide about how strong demand was, and lending is, people are not borrowing so much. The demand side is one issue, but the supply of credit is plentiful. So very, very different state of affairs. So the yes camp here is saying that this time really will be different. We will get inflation. Semiconductors, we mentioned those, very important. Some people call them the same way that rising oil prices amid an oil shortage of the 1970s was a big contributor to the inflation back then. Well, some people are saying the same thing about the semicon shock today. We'll see. They also say that the skill shortage is not just something that's, it's not going to go away anytime soon. One reason of that, very big reason actually, is immigration. So remember that the COVID crisis completely, maybe not completely, but radically reduced immigration. I mean, borders are essentially closed. So you have that constraint. Then you had, previously you had not only during the Trump administration, you did have a decline in immigration and more, let's say, tighter immigration policies, but that really wasn't terribly new. Even if you go back as far as 2010, you had some of these visa laws tightening and things like that. So there really has been a skilled labor shortage for quite some time. So I don't know, is that going to go anywhere soon? And it would go away soon? Sorry, maybe not. You also have, because of the stimulus, a lot of household savings. People feel wealthier because the stock market's going up. So let's spend, spend, spend. There are things that are happening outside of the U.S. too that it's important to observe. One is that maybe hyperbole to say end of the globalization is over. That may not be true, but trade is definitely down. Companies may be thinking differently about their supply chains. They maybe it is cheaper to set up a factory in China, but they don't want to do that anymore because they're thinking more about supply chain resiliency now. What if there's another pandemic? How am I going to get my stuff over from China? I can't, so maybe I'll put it in Mexico because it's closer by, or here in the United States. Even if it's a little more costly, it'll be more logistically easy to manage. So there could be some of that. There's also demographic issues overseas as well. Did I spell aging with an E? Is it the British way? I always forget. Anyway, people getting older. Let's say that. And I did spell overseas wrong, sorry. I'll go back to spelling 101 after I finish this class. Okay, so overseas workforce is aging. China is a good example too. There was a huge supply of young workers coming from rural areas into cities. There's less of that now. You have more of a middle class, well, you do have a higher middle class, but you also have a shrinking supply of very low wage labor in some of these developing nations, particularly in Asia. Consolidation, we've seen some big deals. So specific industries might see higher prices. Railroads, we've had some deals in IT, and even in the semiconductor area, we've had NVIDIA buy a UK firm. So that could contribute to higher prices as well. Tax policies, we may get higher corporate income taxes. Idea being if companies have to pay more, then they'll be under more pressure to raise their prices. I want to end this slide on this idea of the 3 H's, I like to call them. And what we're talking about here is really higher education, healthcare, and housing. And those 3 things, they really, if you look back over the past, people will say, well, there hasn't been any meaningful inflation in decades now, since really the 1970s. And yeah, that's true. But then, the retort to that will be, yeah, but is that really a good way to measure how people really experience inflation? The average American middle-class family is, or has been over the past decades, spending a lot more money on health insurance premiums and sending their kids to college and housing, particularly if you live, ironically enough, in the places where a lot of the best jobs are. You just can't afford a house. So that's been a restraint on labor mobility, which is an issue for the economy for sure. So it used to be like a typical thing would be you live in some factory town in the Midwest, factories closed, but you can get a unionized job at a casino in Las Vegas. You saw that like huge in the 90s. That was like a really huge shift, even 2000s, like almost like a safety valve. It's the pressure valve, kind of released by people moving. Nowadays, sure, you can absolutely find a job in Seattle. Good luck finding a house you can afford there, or even an apartment you can afford there. You have to be making an extraordinarily amount of money, and that's that requires only only limited people are going to have those kind of skills. Not everybody can program an artificial intelligence robot or whatever. So that's there are compelling arguments there. I'd be curious to hear what some of you think, if you agree with that. But let's present the other side. There's move forward here. There are just as many people and arguments that that say no, there's not going to be inflation, and they'll point to the fact that a lot of this stuff might just very well be short terms. I mean, short term. Some of this stuff with rising commodity costs and shipping. I mean, a lot of that was due to just one-off factors. Bad weather. We had some storms in Texas that shut down the energy grid for a while. That messed up factories. We had a big boat stuck in the Suez Canal that like blocks shipments all over the world. So there's always like kind of weird things happening in the first quarter of this year that kind of messed up supply chains. But is that going to cause long term? So no, that's just temporary. So there's that. There's also, remember, we've had such in the past, since the start of COVID crisis, we've had these like extremely crazy swings in demand. And it's been like near impossible to plan for stuff. So, a great example would be like in this week's issue of Econ Weekly, we talk about this a lot. There's a railroad who was talking, CSX down in Jacksonville. They're talking about how back in the beginning of 2020, so before the COVID crisis, things were looking outstanding in terms of demand for automobile shipments. Then suddenly you have the COVID crisis hits, and the demand just falls off the cliff. It goes to zero. So you take decisions. Trains a little different, but you take decisions. The auto companies themselves, for sure, are taking decisions with their supply chains. Let's maybe cut back on production because we have this like awful demand shock. And then like 2 months later, 3 months later, and the demand is really strong again. And then what happens? So demand's going strong, going strong, going strong. And then you have the semiconductor shortage and you can't produce enough cars. So it's been a very, very unusually difficult period to plan supply. And according to some people, that is very much a temporary phenomenon. Now, uh, demand side too could be the huge kind of increase we're seeing could be temporary as well. And why? Well, it's, the stimulus is going to wear off eventually, and the Fed is going to tighten eventually. So and I should add that we may also see a shift in demand from, instead of people maybe spending a lot of money on, Peloton bicycles for their home, they will spend that money on, taking a trip to California this summer or something like that. So it could just be, more of a shift in demand than a continued increase. We mentioned that the banks weren't lending. So, it's the Fed only controls the money supply. They don't control is a bad word. The Fed only influences the money supply to a limited extent. Even more of money creation happens in the banking sector through bank lending. So if there's not a lot of bank lending, then there's not a lot of money supply creation. So you don't have that sort of, we call velocity of money turnover that you would have to cause inflation. So there's that labor price pressure might also ease, as we mentioned. People get back to work because the unemployment insurance bonuses wear off in September, or because people feel safer to go back to work because they've been vaccinated. That could be too. And then you still just have this ongoing downward price pressure from global competition. You still have, even if workers in China start to become more expensive, you just go to Vietnam. You have this whole concept, this global dollar shortage. That's a little bit, we talk a lot about that in the current issue of Econ Weekly. So if you want to read more about that, you can. But its basic idea is that there's just not a lot of lending is happening abroad because they can't get access to dollars to use as collateral, et cetera. Demography is perhaps deflationary because the global population is aging. That's pretty much true all around the world, certainly absolutely in the United States, where people are getting older, and that entails different consumption habits. So you can picture, a person in their 30s is going to buy certain things. They might buy a big house, they might spend a lot on, maybe education for their kids, and that spending habits are different when you're retired. So the fact that we have more retirees could influence the demand equation as well, and probably in a way that's actually more deflationary than inflationary. Amazon and Walmart effect. I mean, these companies are just, they're masters at lowering costs, driving down, driving down distribution costs. They're just, they don't compete on they don't earn, first of all, they're pretty low margin companies, I should add. As hugely influential as Amazon is, its profit margins are really not that high, and they'd be a lot lower too without their cloud computing division. So but they're experts at pushing prices down. That's how they compete. They are raising wages for sure, so maybe they won't get away with that for long. I don't know, but don't discount that. Those kind of companies didn't exist in the 1970s. The internet didn't exist either, and consumers can just shop around so much easier, and you can buy stuff from anywhere in the world with a click of a button. Finally, there's these in this section, these concepts of the intangible economy, the creator economy, the sharing economy. These are also concepts that we talk a lot about in Econ Weekly, and I probably shouldn't spend too much time here, so not to make this presentation too long. But the intangible economy, for example, is just this idea that a lot of the big companies, Amazon is a good example, or a better example would be like a Google, where a lot of their profits and their production is just, they're producing ideas. Really, they're not very labor intensive. So they, they're producing like some algorithm which changes the world, but it doesn't, it's not going to create. You're not. It's not very labor intensive, so it's not going to drive up cost. Yeah, same thing with the creator economy. This is what we talk about. People just interacting directly with customers via platforms like YouTube, where you can, or TikTok or whatever, you can just sell things directly um, to people, and that sort of cuts out some members of the distribution chain. Perhaps you can do it at a lower cost. And the sharing economy is this idea. Uber. All of a sudden, you have all of these cars that are adding to the supply of existing cars by being utilized in new ways. Same thing with like hotels with Airbnb. So these are all things that are different about the economy in 2021 than they were in 1978. So important to remember that. Are productivity gains coming? Nobody knows for sure, but there are a lot of interesting technologies like 5G telecommunications that's going to make communications like just a lot faster. Uh, and in the same way that Uber couldn't exist without 4G communications, well, maybe there's going to be some new ideas as revolutionary as Uber with 5G. And then you have artificial intelligence, which is really it's applicable for industries throughout the economy. And then this whole idea, which absolutely fascinates me, is the crypto space, the crypto economy. And that's for another presentation. But there's this whole ecosystem of people that are trying to rewrite the rules of finance, and completely decentralize all that, which could be a very cost saving, deflationary type trend in the future. Now that's probably at least a few years off. The cost of capital is still extremely low, so if people are paying very low interest rates, that's another reason why they might not have to raise prices. Energy is also reasonably priced. I saw, I was looking at as an old airline industry guy, I always peek at the airline earnings, and I saw, I think it was Delta, was only, their fuel price was still, their average fuel price in first quarter was still, historically speaking, still very, very low. Yeah, it's a lot higher than it was 12 months ago, but it's not, these are not the days of $130 a barrel oil either, like they were in 2006, 2008, 2006, 2007, and then into mid 2008, I guess, is when they crashed in August or whenever it was, September of that year. Okay, year-over-year base effects. That just simply means, inflation is going to look bad right now. The numbers are going to look bad because we're comparing to last spring when things were, when just the world was falling apart. And then there was those, one-off shocks like the Texas storms as well is going to kind of make the numbers look a little screwy. And then Fed tightening will come. If there are any signs of inflation, well, they'll just tighten the screws and everything will be under control and all will be well. Remember the early 2010s. What I'm talking about here is that you did have a situation where oil prices were over $100 a barrel for, I think, three consecutive years, like 11, 12, and 13. And most of 14 as well. Like oil prices were very high. And believe me, I know, because I was in the airline industry, writing about the airline industry then. So I remember that very well. And we had, all the Fed loosening, all that kind of stuff, back several years before that period. But you had no inflation. Like across the economy, it never really was a concern. It's so, it's why worry about it this time is what some people have to, will argue. And there are, I'm not going through every single argument here. We do a more detailed look in our issue. This is our last issue, 16, so you can check that out if you want. Happy to email you a copy if anybody wants to see it. Okay, so a few risks to the economy beyond inflation. I just mentioned a few here. One could be that stock markets and other kind of markets are just kind of bubbly. They sure look that way. Although, you hear people use different measurements and say, well, it's, all things considered, it's not so bad. But it's there's been a lot of new money, getting plowed into the stock market, driving up prices. These SPACs, these, type investments are all look a little bit bubbly. We'll see. I mean, even the Fed thinks so, or at least acknowledges that it might be a risk. When the Fed does kind of withdraw, that does become a risk. Now, back in 2013, I think it was, they did start to withdraw from the 2008 stimulus, and it caused problems. Like it did, particularly abroad in emerging markets and stuff. It caused what people refer to as the taper tantrum. Taper being like it's kind of the withdrawal, and yeah, it was problematic. So maybe that's a risk when they finally come to having to raise interest rates. The other issue with raising interest rates, when it comes to that, is that it does make all this new government borrowing, not just in the U.S. but abroad, more expensive. So that's, I mean, future borrowing anyway. So that becomes, that becomes a risk as well. This is a little bit esoteric here, but the instability of short-term funding markets. Um, a lot of companies and banks depend on these kind of overnight lending markets that are based on treasury collateral, things like that, to sort of make it's a very important part of the economy that's often overlooked. It's kind of like the grease in the wheel, so to speak. It's the plumbing. And these markets actually, they broke down in 2008. They started breaking down actually a couple of times more recently too, including last spring. The Federal Reserve had to step in, and they'll tell you, the Fed itself will tell you, like, these markets are, we need to do something with them because they're a little, they're shaky and they've got problems. So there might be some risk there. I mentioned the rise in interest rates, and another point there is that, of course, you could argue that the most important industry in the United States is housing, and if once interest rates start to rise, then it becomes more expensive. People take a mortgage, that reduces housing demand, so that would not be good. Commercial real estate, we talked about in the first or second slide. Auto loan defaults, that's, it's not huge. It's probably not systemic, where it would, kind of take down the whole economy like the housing loan defaults did in 2008. But yeah, it could be a little pocket of pain there. SLG, again, state and local governments, a lot of states, including my own state, New Jersey, has big pension underfunding problems. Heard arguments that this is less of a concern that some people worry, but who knows? And then the virus itself hasn't gone completely away. You don't know what it's going to do, especially with it being so bad in places like India. Could there be a mutation that comes back to the U.S. and is resistant to the vaccines that we're able to produce? Hopefully not, but that is a risk. I always like to mention the elephant in the room, which is the healthcare sector. Why is it the elephant? Well, it's just so giant. And another big difference between the 70s, by the way, is that the healthcare sector is now like almost a fifth of the entire US economy. And it's everywhere. You can just see it. I mean, a good exercise is like next time you're driving around, just look around you, look at the office parks, look at the the jobs that people would have in places as you drive down the road. So much of it is healthcare. I mean, doctors' offices and hospitals and outpatient clinics and radiology. I mean, it's just everywhere. Health insurance is just this massive industry. So it's always you can never, when you're talking about inflation, you can never like do an analysis without kind of looking closely at what are the trends in healthcare. And so is there alarming healthcare and inflation right now? Well, actually, I mean, as we mentioned earlier, over the past, few decades, inflation has been a really like fast growing part of the economy, with prices rising a lot. And at the same time, the rate of healthcare growth, cost growth or pricing growth has kind of moderated. So, is there anything unique about this situation and the crisis that makes healthcare inflation alarming? Probably not. In fact, if anything, there's like forces pulling in both direction. So I remember one healthcare company, you'll remember this if you saw our issue 2 weeks ago, whenever it was. There was one healthcare company that said, yeah, we're starting to see, demand pick up because people who were, not getting procedures done when COVID was a risk, they're starting to come back, and that's, maybe pushing up prices. But at the same time, like pregnancies are way down, so people are not, doing that. And the other important thing, I'm talking about supply and demand here in the healthcare sector, but it's the healthcare sector. It's prices are not even really determined by supply and demand. They're so influenced by government policy, and it's such a the best example of why traditional supply and demand economics don't work in the healthcare sector, or don't. Some people argue they do, but don't work very well. Is when I'm laying on a gurney and I just had an accident and the doctor says we need to remove your brain, and I say, oh, let me shop around. It just doesn't happen. So everything is the sort of the dynamics of the sector are not the same as in normal sectors. So just keep that in mind. And there's nothing right now like terribly alarming about inflation in the healthcare sector. I mean, is there a shortage of nurses? Absolutely, but that's been the case for years now. So, and then always keep an eye on government policy with healthcare, and always keep an eye on productivity gains. The sector has for a long time kind of been immune to a lot of productivity gains. Tremendous amount of innovation in terms of mRNA vaccines are the best example of that. I mean, just American ingenuity is just absolutely incredible, and also credit to global supply chains. I mean, a lot of that stuff was done abroad as well. But will there be any new technology that actually lowers the cost and sort of makes things more productive? And it's kind of the weird situation in healthcare, and sorry to ramble on here, but it is really just such an important sector. If you think about if a doctor sees more patients per hour, that would be considered more productive in a sense, but it's also like not really good for the patient. The patient wants to spend more time with the doctor. So it's kind of an odd sort. It's not like producing widgets, or, it's where you're just trying to, so it's always been very hard. Now, what could be different now is these technologies like telehealth, where I don't have to go into the office to see the doctor. I can just, do a Zoom call or whatever. That could be a big productivity gainer. So there's stuff like that. Microsoft just bought a company called Nuance, and they do a lot of healthcare, technology involving, text to audio, or I should say, audio to text, I guess, whatever it is. But anyway, they're trying. I mean, Microsoft is a good example of a company that's very much trying to apply the latest technologies like artificial intelligence to the healthcare sector. So will they succeed? Let's hope so. There again, final point is that this time is very different from the 1970s, completely different structure of the economy. For one, labor is just, they have a lot, their pricing power is much, much less today because of, unions are much weaker, and, they're not working in, huge amounts of laborers in one physical location like a factory, where they can easily organize. And laws have over the years have actually made it somewhat more difficult to organize as well. I mean, we saw that, the Amazon down in Alabama, they had a unionization attempt that didn't work. So unions just not the factor that they used to be. Globalization is much more than it was today. Is it over? That remains to be seen. So what's skeptical. And then it's intangible economy. Again, like you're not the big, if you went in 1970, what was the biggest company in the United States? I don't know the answer, but it might have been this probably late for General Motors. That was probably more in the 1950s and 70s. But anyway, let's just say it's a company like General Motors. Well, that's a very, very labor intensive, capital intensive industry. whereas software is very much not. It's an intangible type business where, you know, it's you're creating software, which is, creates a very limited, is created by a very limited number of software engineers, very highly skilled, but it's not, it's just very different. And then, as I mentioned, services like healthcare are a much bigger part of the economy today. Okay, yeah, and I guess I just want to say lastly to keep an eye on that crypto economy. I don't know if it's going to, there's certainly aspects of it that raise questions, in terms of its energy usage and things like, right now, some of the platforms for conducting transactions are extremely, extremely slow or just inefficient. They just don't have the ability to process nearly as many transactions as like, some other existing networks. So, who knows, but it is just a very, very interesting thing. And, one way to think about it, this may not be, someone might quibble with this, but the way I kind of think of it, in part of it in my mind is that, the crypto is like creating the blockchain essentially, which is the technology underlying. It's almost like a platform that sort of runs on its own. So if you think about, even something like, Amazon is a selling platform that, third parties can come on and conduct transactions, but it's not really peer to peer. There's still a middleman. Amazon is still in the middle. But with blockchains, there's nobody in the middle. It's just the technology is kind of self-sustaining. So it makes it kind of really interesting. I mean, for any platform company too, it's something to, something that they're going to have their eyes on. Even like a Facebook is a social media platform. Can you do that? Can you have like a peer-to-peer type thing in a blockchain? I don't know. And then of course, most interesting right now for blockchain is even less so, Bitcoin and currencies. That tends to get a lot of talk. More interesting to me, I think, is some of this what we call DeFi or decentralization of finance, where all these people are trying to create blockchain-based applications that do what banks do, but on the blockchain. So theoretically, with a lower cost, and with, in some cases more functionality. So anyway, that's for another discussion. But thank you for joining. If you have any questions, or for whatever reason you want a copy of these slides or copy of some old back issues, yeah, definitely hit me up with an email. And definitely sign up for a free trial too. We don't need your credit card information or anything. Just sign up, and that's my email there. And thanks. And yeah, I hope this was useful. And see you next time. Thanks.